Welcome everyone. Thanks for attending today. I'm Patrick Polk, Content Director at Betashares, and presenting today will be Tom Wickenden, one of our investment strategists. Tom is a member of our investment strategy and research group, and he's a CFA Level 2 candidate. Today's topic is harnessing the benefits of ETFs in your portfolio. We'll be covering the benefits of ETFs, how to use them in your portfolio, why they have the potential to outperform actively managed funds through various market conditions, and we'll take a peek at what the future of the industry could look like. Before we get started, please have a quick read over this important information. Of course, past performance is not an indicator of future performance, and anything we cover today is general in nature, so it doesn't take into account anyone's personal situation. It's best to seek professional financial advice for that. The webinar will be recorded, so if you miss out on anything or you want to share with friends, you can watch it back later. You'll receive a link in your email later today, or if you check out the Betashares YouTube channel in a day or two, it will be available there too. We will have time for questions at the end, so if you do have any questions for Tom, you can ask it using the panel, as you can see here on the slide. We'll endeavour to answer as many of the questions as we can, but unfortunately can't promise to answer them all, but we will try. Make sure you check out our website, betashares.com.au, where you can find all of our latest information, as well as plenty of content, including insights and education. And of course, we are on all the major social media platforms, so you can find us there as well. That's enough from me for the moment. I'll pass it over to you now, Tom.
Thanks very much, Pat, and welcome everyone to today's webinar. Just before we get stuck into it, a little bit about Betashares. So Betashares have been ETF managers in the Australian market for 14 years now. We're the second largest fund manager in terms of funds under management in the Australian ETF industry. And we actually offer the largest range of ETFs to Australian investors, really with the aim of helping Australian investors achieve their investing goals. Pretty proudly, we have actually been the #1 in ETF or asset manager in Australia in terms of inflows over the past 12 months. That's quite good given the difficult market environment we've seen. It's quite a good testament to the range and quality of ETFs we do provide. Interestingly too, you will notice 3 of the top 4 names on this list, being Betashares, Vanguard and VanEck, are all ETF providers. So we're seeing investors using ETFs as their main investment choice in the Australian market. And we'll get into some of the reasons why in the presentation. As Pat touched on up the top, today we're going to talk about how to think about building a core portfolio. We're going to talk about the difference between active funds and passive funds and which ones may be more appropriate for that core part of the portfolio. And finally, just look into fixed income ETFs and fixed income more generally and how that fits within a diversified portfolio. So firstly, thinking about how to build a core portfolio. And before we get there, I guess, what is the core part of a portfolio? When we refer to the core the portfolio, we're really talking about the part that has the majority of the invested money within it and held for the long term. So for those reasons, it's really important to get the core part of the portfolio right. And it starts with asset allocation. Every individual investor will have different goals and different outcomes they're trying to achieve from investing. The first step for investors is to understand what their goals and objectives are. And that'll help them understand what risk and return profile they have and what asset classes they should choose. When I say asset classes, I mean things like equities, fixed income, commodities, and cash. And even within those asset classes, we can think about Australian equities, international equities. We can think about floating rate bonds and fixed rate bonds as well. And each of these different assets has a varying degree of risk and return to them. Typically equities have a large amount of risk or volatility, but they typically have a higher return when compared to, let's say, fixed rate bonds, for instance. And what research has shown is investors choosing the percentage to allocate towards different asset classes, so their asset allocation weightings, is actually the largest determinant of portfolio movements over time. So about 94% of a portfolio's movements is determined by what asset classes we choose and what weights we choose in them, rather than security selection and market timing, which actually makes up a really small percentage of the overall determinants of portfolio returns. So one of the great benefits of selecting different asset classes and using those asset classes together is benefits we get from diversification. What I mean by this is once we've decided, I want to put some money into equities and put some money into bonds, by mixing these two together and choosing a certain level of risk or volatility we're comfortable with to achieve our investment outcomes, when these asset classes are not correlated to one another, we actually benefit from diversification and can get greater expected returns for the same amount of risk or volatility. Taking a quick step back and providing a bit more of a real world example of asset allocation, if we think of a younger investor with a very long time horizon and a high propensity for risk, they might have a lot more money in the equity side of things, which has that greater risk and return profile. If we compare that to, say, a much older investor who has a large pool of assets and is looking to maintain that pool of assets and gain income from it, they might have a much larger weighting towards fixed rate bonds, for instance. Now, when we think about the core part of our portfolio, as I described earlier, that long-term anchor of our portfolio, there are particular attributes we want to achieve from the investments we invest in. So what I mean by this is if you're looking to a product or a particular fund to invest in for the core part of your portfolio, you want to make sure it ticks a few boxes. Namely, it provides asset class exposure. So if you've decided what asset classes you want to put your money into, you then want to make sure the investment you choose is actually giving you exposure to that asset class. We want these investments in our core of our portfolio to be able to be held for the long run and offer compelling value over the long run, particularly compelling value in terms of net of fee performance. And finally, as we touched on the last slide, we can seek to reduce the overall volatility of the portfolio by mixing these asset classes or these investments together and benefiting through diversification. And we can see here the performance of a lot of the major asset classes over the past few years. On the left-hand side, we have equities there, and on the far right side, we have commodities. And you can see it's been quite a difficult environment for investors. There's been quite a lot of volatility across asset classes. There's a few key takeaways we can take from the past few years and this performance slide. Firstly, it's really important for investors in that core part of their portfolio to take quite a long-term perspective. If you're investing in equities last year, you might have been quite discouraged by the performance. We have to remember, single year performance won't affect or won't determine our goals over 7, 10, 15 years. So it's really important to stick to your investing goals and stick to those asset allocation decisions. The other key point from this slide is diversification is really crucial. If you had a portfolio with some equities last year and some commodities, we can see that, the commodities basket third from the right there performed really well when equities didn't perform very well at all. And that's what we're talking about. We're saying non-correlated assets performing in different market environments. And by mixing these two asset classes together, you can really benefit from diversification in the core part of your portfolio. Now, another really important consideration then is what actual funds are there that you can invest in. And typically there are two main options that investors look to for broad asset class exposure. And those are passive funds and active funds. So what do I mean by a passive and an active fund? Well, firstly, an active fund is typically a fund where you'll give your money to a professional manager who within an asset class, so let's use Australian equities as an example. Within Australian equities, they will try and pick the stocks they think will provide the best outperformance over the cycle. The alternative to that, and through ETFs, there's been much greater access made available to passive funds or index tracking funds. And these funds will typically track a much broader benchmark without trying to pick individual winners. So again, for the Australian equities example, you could look at the S&P ASX 200, and that just tracks the largest 200 companies listed on the Australian Stock Exchange. So you got broad diversification, you're holding the whole basket of companies rather than trying to pick the winners and losers. Over the past few years, with the really difficult market environments that we have seen, a lot of active managers have been quite vocal in saying it's a really important time to stick with an active manager to provide outperformance. So we thought it'd be worthwhile looking into this and using a few ETFs and active managers for comparison. Firstly, we have some research here by S&P Dow Jones. It's really good research they put out quarterly each year called the SPIVA report. Essentially, what it's showing us is how have active managers performed compared to those broad market benchmarks that we can typically get access to through ETFs over various time horizons. So in those market conditions last year where active managers said it was a really good time potentially to invest with them because markets are quite volatile and they can potentially provide outperformance, if we look at the majority of asset classes, the majority of active managers actually underperformed the benchmark. And we can see it in the graph here. If we focus in on the black line, let's say, again, using Australian equities as our example, those active managers who are picking stocks in Australian equities, of those, less than 50% actually managed to outperform the benchmark over a one-year time horizon to the end of 2022. And what's even more important to understand is over longer time horizons, the percentage of active managers that manage to outperform passive benchmarks decreases quite significantly. So over a 5-year time horizon, actually less than 20% of active managers manage to outperform the broad benchmark. And the reason this is so important in today's conversation is just to understand, those are the two main alternatives you have for investing in asset class exposure. Looking to a more practical example, we've got the returns here of the 5 largest Australian equity funds at the end of 2017 and their 5-year performance. So we can see their performance is fairly correlated to one another. They typically move in the same way at the same time, but some active managers have been able to provide better performance than others. And actually the best performing active manager here, if you had selected that one, would have provided 45% returns or 9% per annum over those 5 years, which is fairly compelling performance. But how does the index or how does a broad benchmark stack up? Well, looking at our Australia 200 index ETF, Betashares A200, in line with the SPIVA findings, only one or around 20% of these 5 active managers managed to outperform our broad market ETF. And you can also see the performance was very close as well. So there's a few key takeaways here. One is, it can be difficult to choose the right active manager. So you're taking a bit of risk in choosing the right one. Whereas choosing the benchmark, you're typically going to outperform the majority of them. Another thing we often hear is investors say, well, rather than choosing one active manager, maybe I should diversify across all 5 of these, for instance. So I put 20% of my portfolio or 20% of the Australian equities part of my portfolio in these 5 active managers. And if you had done that, really interestingly, you would have been better off taking your highest 2 active manager conviction picks. And even if you had chosen those worst 2 performing names and put 20% in each and put the remaining 60% in Betashares A200 ETF, you would have been better off than if you had invested across all 5 of these active managers equally. So, if you're an investor who is married to a certain active manager, it can also be good to blend that with a broad passive index. Finally, on this section, when we look at the blended portfolio of active managers, what we've done here is we've taken a 20% weight in each of those active managers and looked at their performance over the long run. We can see that the performance is actually very similar to the index with underperformance over those 5 years. A key reason for this is the fees coming out of active managers compared to passive funds. Passive broad-based ETFs such as our A200 ETF tend to be very low cost. So, for example, our A200 ETF has fees of 0.04% per annum, whereas the average active Australian equity manager has around 1.2% fees. And just one final point from the S&P report before we talk about fees a little bit more, then get into some other examples of ETFs we can use in our portfolios. Another thing we hear quite a lot of, or was quite interesting to understand for investor psyche, is the thought of picking a good active manager. There can be a perception out there that there are good active managers and there are bad active managers. And what we mean by this is active managers that persistently stay in the top half of the active manager pool, for instance. And look, focusing on the left-hand graph on the screen here, we can actually see that the percent of active funds remaining in the top half after being in the top half in 2019 and 2020 falls off quite significantly each year. So after 2 years, those active managers who are in the top half for 2019 and 2020, 2 years on in 2021 and 2022, just over 10% of those active managers remained in the top half of all active manager performance. So this is important to consider, again, for the core of our portfolio, because we want those investments that can be held for the long term. We don't want to be having to be trading in and out of different managers and trading in and out of different funds. And one of the main reasons, as I touched on a little bit earlier, for the underperformance of active managers can typically be costs. And this was another one of our key points when you're looking to invest in the core part of your portfolio. You really want to keep costs low. It's one of the main controllables investors have, is the fees they pay for a fund. We have a great quote here from Albert Einstein saying, "Compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it." And a lot of investors are very familiar with the concept of compounding interest and compounding returns. The interest I earned last year, I'll earn interest on that again this year. So you're building, or you're compounding over time. Another really interesting way to think about this is in terms of fees as well, because with fees, they also compound over time. They're just compounding in the opposite direction. They're coming out of the value of your investment, and over time that will continue, and the amount that's come out can no longer contribute to future returns. So when we compare, again, using that Betashares Australia 200 example, if you were to invest $10,000 into that fund over 30 years at a 0.04% fee, assuming around an 8% return per annum, which has been about the average for the Australian market, you would achieve by the end of the 30 years around $100,000 in terms of investment returns. By comparison, if we use the average Australian active manager fee of 1.2%, that $100,000 gets reduced to $70,000. So you can really see why having costs low in that long-term part of our portfolio is so important. Now, here's a great example of another ETF we can use side by side or compared to an active manager. So what we have here is moving to international equities, and we've got a tech-skewed, high conviction active manager who predominantly looks at US tech. And you can actually see, compared to their determined benchmark, they've actually provided really good outperformance against the benchmark they've chosen. I guess the important consideration to have here is be cognizant of what an appropriate benchmark may be compared to what a benchmark an active manager is using. And also, more importantly, be cognizant of the different types of ETFs that are out there. So for instance, Betashares has a low-cost global ex-Australia ETF that's not tracking this exact index, but quite a similar one. So if you use that to compare to this active manager, you'd see underperformance. But Betashares also has indices and core indices that track technology indices, like the NASDAQ 100 in the US. And we can see by using a more appropriate benchmark for this active manager, you can actually probably generate outperformance using a lower cost ETF. You can see the performance of these two funds, the active manager and the NASDAQ 100 ETF, rather than the broad global ex-Australia index. You have much more similar performance over the long run, and actually significant outperformance in that downturn period, because the index, again, typically holds the entire basket of stocks, where an active manager will just try and pick individual names, which can lead to some stock-specific risk. And for a lot of these reasons, we have seen quite a large shift in flows in terms of where investors are putting their money from active managers into passive funds. And we're seeing more and more investors using passive funds for the core parts of their portfolios, as well as other parts too, to be honest. And this has really been facilitated by ETFs. ETFs have provided access to investors to a lot of these asset classes through a passive investment stream. It's also been facilitated by education, people understanding some of the facts we just went through, and trusting themselves and trusting their process in terms of asset allocation, choosing the right funds, and sticking with that methodology. So what really are the key attributes of ETFs that investors are coming towards? Well, the first one, we've already touched on it quite a bit, is that low cost. The second is liquidity and ease of access. You're able to buy and sell ETFs on the exchange. With some active managers, particularly unlisted active managers, there can be forms and other things to go through. It's not the same for a passive ETF. The next two, transparency and control and good rear vision mirror, are talking about how much look through you have with an ETF. So by going to Betashares website or any ETF fund manager's website, you can get an idea of what the fund's holding, what index it's tracking, what fees it's charging, its historical performance, along with lots of other great information. So you've got a really good understanding of what you're investing in, a great understanding of why it's performed, how it's performed. And then finally, that final point, ability to well complement other portfolio holdings. That's really talking to the benefits of ETFs, of giving you asset class exposure and making sure those asset class exposures blend well together in your portfolio. And we'll look at an example of this now. So what we've got here is a hypothetical diversified core portfolio for an investor. So we've got, if this investor predominantly equities, so maybe they're a bit younger or have a bit of a higher risk tolerance, but there is a sliver of bond portfolio in there. I still want to focus on the equity side of things for this example. And firstly, looking at Australian equities, we could look to use something like the A200 ETF we've been referring to throughout the presentation. What we'll notice though is in the Australian market, we're quite overweight financials and materials. So if we just held this portfolio as is, that could be an overweight in our portfolio, potentially not the best from a diversification standpoint. So when we look to construct the rest of our portfolio, by understanding what ETFs are out there, we may be able to better balance the portfolio at a sector level and provide better diversification. So by including something like the NASDAQ 100 ETF, the ETF we compared to the tech-skewed active growth manager a few slides ago, you can see that the US market, or particularly this US index, is very overweight information technology and communication services. Now, large US tech companies have driven a lot of growth in equity markets over the past 10 or so years. So by including some of this into our core portfolio, we're able to better balance it from a sector point of view. So we often get a question, is there a right or wrong amount of ETFs to hold in a portfolio? To this point, there isn't a right or wrong amount, but just be cognizant of what you're holding, where you're overweight and where you might be able to better diversify using other ETFs. Now we've covered most of our core equity ETFs there. As I mentioned at the start of the presentation, Betashares actually has the largest range of ETFs available on the Australian market. We've got 81 ETFs now. Today we're just focusing on those that we see as the most applicable for the core part of investors' portfolio. So we've talked about the Australia 200 ETF. Well, I've mentioned the global shares ETFs. That's investing in developed market equities ex-Australia, so they're not overlapping with your Australia 200 ETF. And in the last example, we saw how those two are used together, blended together with a NASDAQ 100 ETF to balance out our portfolio. The final one we haven't touched on yet, but it's worth covering. It's our all growth ETF. This ETF is really good at taking, a lot of the discussion we've just had and putting it under one single ETF. What I mean by that is it invests in Australian equities, global shares, emerging market equities as well. So it's really a one-stop shop in terms of your equity allocation, and can be used as a sole core for some investors' portfolios if that meets your asset allocation requirements, or it can be used as a core part and complemented with, let's say, fixed income funds if you want to include those as well. So then moving on to fixed income ETFs and how they fit into an investor's portfolio. Look, for the premise of this presentation, we're going to focus on, when I say fixed income, we're really focusing on fixed rate bonds. So those are bonds that, you know, either a government or a corporation will issue. There'll be a set coupon rate, so income you're paid back. So you initially buy the bond for an amount, you receive income along the way, and then at maturity you receive your initial amount that you paid back at the end, typically $100. That's a fixed rate bond. Now, for those of you who are, you know, more adept or have been following fixed rate bonds over the past few years, you'll know it's been quite a difficult time for fixed rate bonds. And that means quite a difficult time for investors using a diversified portfolio of equities and bonds. The reason for this is last year was actually the worst year in terms of returns for fixed rate bonds, as shown here as a proxy to the Ausbond composite. Promisingly though, historically, we've not really seen bond market routes last very long. I mean, the previous worst year was back in 1994, and that was followed by 95, which was one of the best years on record for fixed rate bonds. Now, why is this typically the case? It's because as bonds sell off, we see their yields increase. The yield's just the return you receive for holding that bond to maturity. You know, if we can buy a bond for a lower price, it's selling off. You know, the income we're paid is still the same. The amount we're paid back at the end is still the same. So our yield or our return for holding that bond increases due to the lower price. Now you can see back in 2021 or the end of 2021, there wasn't very compelling yields on offer for a lot of the fixed rate bonds. If you look at the 10-year government nominal rate on the graph chart there, for instance, you can see, you know, for holding a 10-year government bond, you would get around 1.7% back in yield over that bond's maturity. Since these bonds sold off quite a bit last year, and we'll get to the reasons why that happened on the next slide, the yields are at a much higher level, so around 4% now for your 10-year government bond. And since they're considered fairly safe and defensive asset classes, or safe and defensive instruments, they can be really good for storing and holding money, and it means there's a greater payoff for holding equities if you can get 4% in a government bond as comparison. Now, when we think about the traditional role of bonds in portfolios, it touches on what I just mentioned. It touches on, you know, you want them to play a fairly defensive role in your portfolio, fairly capital stable, and also have this negative correlation to equities. Investors typically think when stock prices go down, bond prices go up, and vice versa. Now, as I've mentioned, it's not really what we saw in 2022. And the reason for this is the reason stock prices were decreasing was due to the increasing interest rates we were seeing. As interest rates increase, the opportunity cost of holding equities also increases. So more people might put their money in cash rather than putting their money in equities, which can be a bit more risky. However, under these circumstances, we also see bonds sell off as there are higher interest rates. You know, governments and corporations will release new bonds with higher coupon payments, making our existing bonds worth a little bit less money. And that's what we saw in 2022. Promisingly, and this goes back to how historically bond market routes have not lasted long, we've seen a shift in dynamic in 2023. We've seen higher yields and higher return for holding bonds. We're also seeing market sentiment shift towards fears of, you know, the fears have shifted, from interest rates increasing, the effects of those interest rate increases. And what we mean by that is people are looking forward and thinking, well, we might be getting to the top of interest rate hikes, and potentially, since we have high interest rates, there could be more pain for the real economy and for company earnings. And that's when historically we've seen this negative correlation between bonds and stocks exist. And it's what we've seen in 2023. We've seen a negative correlation between these two asset classes return and them playing a traditional role in portfolios once again. So looking at options for investors, again, we'll look at some, you know, active funds in fixed income and a passive fund in fixed income. You can see here, unlike the equities active managers, there's actually quite a narrow dispersion of returns over the past 5-year period. Oh, sorry, this is much longer term, over the past 11-year period for fixed income managers. mean, over these 11 years, there's actually only an 8% difference in the best and worst performing active manager. It's much harder to generate alpha for fixed income active managers. You can see, however, though, that some of these active managers have outperformed the AusBond composite, which they use as their benchmark. And again, it's another important reason to understand what different types of ETFs are out there, because Betashares, for instance, put out our Enhanced Composite Bond Index ETF, OZBD, a few years ago. And by taking similar risk and return profiles to the AusBond composite, but weighting the bonds in a different, smarter way, you could say, still based on a rules-based index, you end up with a portfolio that's more similar to an actively managed fixed income portfolio. But since there's much lower dispersion of returns, the lower fees of OZBD has led to quite significant outperformance over the long run. So just in terms of, again, focusing on Betashares core asset class funds across cash and fixed income, OZBD is the one we just touched on. So that low management fee of 19 basis points, which is around typically half, if not less, of the actively managed bond funds, provides that outperformance over the long run. And the other core ETF we have is our high interest cash ETF AAA, and that's just for a cash allocation, which cash is also an asset class that investors consider when investing. Obviously, very defensive and generates some income. The reason you consider AAA is if you had a lot of cash sitting on platform waiting to invest it, you can get a pretty compelling interest rate of 4.18% net of management fees. Has performed fairly well over the long run against comparable indices and short-dated government bonds as well. That takes us to the conclusion of the main part of our presentation today. As Pat mentioned, we will get to some questions that have been coming through in a second, but just to summarize all of that in one slide, you really want to initially take a step back and think about what are your investing goals and outcomes, and then understand the different risk and return profiles of different asset classes and understand how you want to weight those together. Once you decide that, using broad market capitalization ETFs that are low cost and provide good asset class exposure are a really good vehicle to invest in for the long term, particularly compared to some of the active management performance we've shown today. Finally, using different core ETFs together, we have to be cognizant of our overweights and underweights and how to improve diversification. That was to that A200 and NDQ example. And finally, fixed income ETFs be used again as a defensive allocation to help improve portfolio diversification. And look, to find out a lot more information on our core ETFs, each of the funds we spoke about today, and some of these key advantages, you can go to our website and there's a link there, www.betashares.com.au. There's actually a specific core landing page at the moment as well. And just finally, before we get into questions, a few things to consider. The value of investors' portfolio can go up and down. So there's obviously risk with equities and fixed income exposures. There are no guarantees, so future outcomes are uncertain. We've shown past performance throughout this presentation, but past performance is no guarantee of future performance. And obviously today, I don't know any of you individually or personally, so none of the advice or instructions given today are taking into account those circumstances, and they do not. It's not personal financial advice. Sorry. And also, investors should and can seek professional advice in terms of advisors if they feel the need to before investing. And on that note, Pat, I might throw back to you to ask a few questions that have come through from the audience.
Thanks very much, Tom. That was a great presentation. We've had a few really interesting questions come through from the audience. So I thought I might just start with one about the number of ETFs you should have in a portfolio. Broadly speaking, obviously we don't know individual circumstances here, but how many ETFs should somebody consider having in their portfolio?
Yeah, it's a really good question and a really common question we get as well. And to be honest, there's no right or wrong answer. I mean, once we've decided that asset allocation mix, we can select, any number of ETFs to meet those requirements. And again, we're just talking about the core part of our portfolio here. You can also have satellite positions in things like thematic ETFs on the side as well. But if we use our DHHF ETF as an example, the all growth ETF we touched on, for some investors, that single ETF could provide their entire portfolio. On the other hand, you can invest in the A200 fund we mentioned, the NDQ fund, the BGBL for that equity side of things, and then something like OZBD for the fixed income side. So it really comes down to the own person's goals and asset allocation requirements.
Thanks very much. Yeah, there's certainly plenty of options out there. There's a specific question we've got here regarding fixed interest, which I thought was an interesting one. Could you explain how a fixed interest ETF works relative to interest rates? Like as they fall, as rates fall, that is, do they benefit from higher rates and capital growth as bond prices rise? So what's that relationship, I guess, between rates and fixed rate bonds?
Yeah, no, that is an interesting question. So when you're looking at a bond fund or a bond ETF, that is holding an underlying basket of any number of fixed rate bonds. So with fixed rate bonds, that traditional relationship between bonds and interest rates is when expectations of future interest rates increase, you typically see bond prices decline. And that's what we saw in 2021 and 2022. On the flip side of that, when we see interest rate expectations decline, so if you think the economy might come into some trouble, or if inflation comes under control and central banks can then reduce their interest rates, you typically see the prices of bonds increase, and that is reflected in the value of the bond fund. So as the underlying bond prices increase and decrease, as will the price of the underlying, or as will the price, sorry, of the fund that's holding those underlying bonds as well.
What about kind of choosing ETFs based on the investor's age? So the person here asking the question has said that they're 50, they've got a daughter who's 20. Would they be looking at the same or different kind of ETFs? And how should investors be thinking about ETFs based on their age?
Yeah, okay, that's another good one. Different investors from different ages can use the same ETFs, right? So say you've got an older investor with, they're trying to preserve their capital in a way, and a younger investor who's got a long-term time horizon. They might still both use an Australian equities ETF like A200, and they might both still use, a broad global ETF like the BGBL, our global shares ETF we mentioned. They might just do so in varying weights, and they might just do so matching them with different ETFs. So for instance, again, completely hypothetical, but a younger investor or investor with a long time horizon and a high risk tolerance might use more of the Australia 200 ETF and more of the BGBL ETF and even more of that NASDAQ 100 ETF and potentially not look to or just use a little bit of a bond ETF. On the flip side, the older investor in that hypothetical example could look to use those same ETFs in smaller weightings and have a larger weight to defensive assets like cash and like bonds. So they can use the same ETFs, they might just use them in a different manner, is the answer to that question.
We've actually had a couple of different people ask a similar question here, so thought it would probably be a good one to bring up. What are, I guess, some of the pluses and the minuses of using thematic ETFs versus, more broad-based ETFs?
Yeah, another good one. So thematic ETFs, so yeah, we've focused our conversation today on that core part of the portfolio, and you typically wouldn't see thematic ETFs in that part of the portfolio. Thematic ETFs are typically looking for structural growth trends. So let's use an example, like electric vehicles. Electric vehicles and the infrastructure around them is what you would consider a thematic ETF. The ETF invests in a lot of the underlying companies in those industries. Now, thematic ETFs typically are targeting higher performance or higher returns. That comes with it higher risk as well. So when we think of the whole of our portfolio, we have the core in the center, that long-term anchor, And we could use thematic ETFs around the edges for areas we're interested in, areas it's okay maybe to trade in and out of because they've got not as much of our capital invested in them, and try and generate alpha from that. You also can benefit from diversification from thematic ETFs. A lot of the companies in thematic ETFs aren't necessarily held in broad market benchmarks, or maybe not to a high weight. So you can add diversification as well through the use of thematic ETFs.
Another one that's come up a couple of times is just comparing cash at a bank versus a cash ETF. How are they different? What do the returns look like? Maybe you could just explain the comparison there.
Yeah, exactly right. So, we'd all be very familiar with investing cash at a bank and the varying amount of interest rates you can get from doing so, and the varying compliance side of things. With a cash ETF, so it trades on the ASX just like the rest of our ETFs. The actual underlying assets of the ETF are invested in deposit accounts with banks, primarily deposit and some very short-term call accounts. So from an investor's perspective, you invest money in ETF on the market, you still receive monthly income as you would an interest-paying account. The way the rates differ, it depends. So you can see the net interest rate of our cash ETF, which is 4.18% at the moment, which may vary compared to your bank at home. But yeah, I think the key considerations are it's still the underlying invested in cash. You still receive the monthly income that you get from the interest payments, and you can still get your money in and out on the exchange in the ETF as you need to.
Now, I'm sure you've heard this question before. It's one that pops up from time to time. What would happen to the ETFs if the issuer of the ETF were to go into liquidation for whatever reason?
Yeah, no, really, really important question. There's plenty of information about this. The way ETFs are structured, the actual assets underlying them, they're safeguarded. So if Betashares or any other ETF issuer were to go bankrupt, there would not be access of those investors' funds by the liquidators. What would happen in practicality? One of two things: another ETF manager might come along and take over that ETF and start managing it with the investors' money, or there'd just be a final distribution made. So the assets in that ETF or all the ETFs would be paid out to the actual unit holders of the ETF. So no, there's quite strict rules around ETFs and safeguarding those assets for investors.
What about commodities? Would you consider them to be an important or an essential part of a portfolio? And just something I'll add to this, could you explain maybe the difference between like a commodity ETF and an ETF that invests in, say, producers of commodities?
Yeah, okay. No, two good questions. So if we remember back to close to the start of the presentation on the asset class return slide, we did have commodities down there on the right-hand side. So it is a major asset class. What was the main question? Are they essential in a share portfolio? Again, just like how we've spoken about all the other asset classes, they're not necessarily essential. However, they can add fairly good benefits to investors' portfolios if investors are seeking those benefits to meet their investment outcomes and meet their objectives. So in the example we used, the returns from 2021 and 2022, we saw last year commodities performed really well when equities performed quite poorly. So if you did have equities in your portfolio, then you would have had more stable returns over the 2 years, as in 2023 so far, commodities have performed quite poorly and equities have performed better. So there is a place for them. They're not necessarily essential, but again, it comes down to investors understanding the risk and return profiles of that asset class, and then seeking to use them if it benefits their overall objectives. And to your question, Pat, a good one to raise. So there is a difference between a ETF tracking or aiming to track a commodity and an ETF tracking commodity companies. Let's use a few of our ETFs as an example. So we've got our fuel ETF, FUEL's ticker code, and that tracks global energy leaders. So that's holding the actual equities of large global oil and gas producers. We also have an ETF called OOO, and that aims to track the price of oil through futures contracts. So one's aiming to get exposure to the price of the commodity, the other's investing in the companies. I probably should caveat that OOO ETF is quite a sophisticated ETF and takes a bit of research to understand what's going on. So please do read the PDS or TMD if you were considering an investment.
If managed funds were struggle to outperform, I should say, a passive index, why would an investor not focus on indexes over the people? Do managed funds pay out more to account for the higher risk, for example?
So you're saying, why would you consider an active fund over an
Yeah,
index?
well, the question is actually phrased as why would they not? But I think you could probably answer it either way.
Yeah, look, you know, for a lot of investors, what's an interesting way I can think about it sometimes is, you know, as your defaults, you could look to an ETF. You know, is there an ETF for the broad Australian market? Is there an ETF for the broad US market? How has that performed? And that could be your default. Then you could go out and say, okay, you know, here's a list of all these great active managers who are saying they can outperform. Have they actually done so? You know, not against their benchmark, but against an appropriate benchmark. When we looked at those performance slides, we were looking at total return. So that includes, you know, capital return and the actual income coming in. But there are some areas, you know, some areas typically that are outside the core parts of portfolios where active managers, you know, play a role that ETFs don't yet. So things like, you know, alternative investments where, you know, it's hard to have those in an ETF structure. So some particular areas, I think, you know, historically, a lot of investors have asked that question and there wasn't an alternative, so they looked to active managers. I think the reason we're seeing so many flows into ETFs and particularly passive ETFs over the past decade, both here and around the world, is because a lot of investors are realizing the, you know, the true benefits of passive investing, and that maybe, you know, in a lot of areas, active can't actually provide too many advantages.
We have a question here about the New Zealand offering. Is that something you're able to speak to, or should we maybe take that one on notice and get back to the person who asked that question?
Yeah, we can get back to them. I think that's, it's not really needed for the broader audience.
No,
Yeah.
that is fine. There's actually a couple of questions here that I think lead to a similar answer. So I might give you those here. So there was a question about getting the data on ETF prices versus net tangible assets, and when the dividends are paid. Apparently, that's not always published on broker websites.
Yeah.
And there was another one just about, you know, kind of learning how an ETF is performing as well.
Yeah.
Could you tell us where people might be able to find that kind of information?
Yeah, no, all good questions. And, you know, the best place for all of that information is going to be the fund provider's website. So, for instance, our website, www.betashares.com.au, we've actually got an individual fund page for each of the funds we spoke about today and all of our 81 funds. And there's lots of good information there about, you know, what the fund aims to invest in, the fees, the performance, how often it distributes, what it's historically distributed. So really the starting place is to go there, and you can learn a lot more information. There's plenty of education or materials on there as well. So really, you know, as a good summary to the entire presentation, head there, and a lot of this information is on there.
Great, thanks very much, Tom. I think we're pretty much out of time at this point. Just for those looking to navigate the website, if you just go to betashares.com.au, if you're looking for fund information, you can just hover your mouse over where it says funds, and you can go either to view all funds or explore our funds, and you can find all of the fund pages through those links. But I think that's just about all we have time for at the moment. Thanks to everybody who's attended and asked questions, and thanks very much to Tom for presenting today.
Yeah, thanks very much, Pat, and thanks for everyone joining and who's watched the recording.